basics, and other items. In this video lesson, we will cover some individual tax basics and a few other items. To claim a dependent, a taxpayer cannot themselves be claimed as a dependent. The person being claimed must be a U.S. citizen, U.S. resident alien, U.S. national, or a resident of Canada or Mexico. And the dependent cannot file a joint return for the year unless they did not have a separate filing requirement and filed the joint return only to claim a refund. Specific rules to be claimed as a qualifying child. Relationship. The dependent must be son, daughter, adopted child, stepchild, foster child, or descendant of any of them, such as a grandchild. Brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them, such as a niece or nephew. Age. At the end of the filing year, the child was younger than the taxpayer and younger than 19. At the end of the filing year, the child was younger than you, younger than 24, and a full-time student. In other words, age is dependent on whether or not they were a full-time student. If they're a full-time student, they can be a bit older than if they were not. At the end of the filing year, the child was any age and permanently and totally disabled. Residency. Child must live with the taxpayer in the United States for more than half of the year. Support. The child must not have provided more than half of his or her own support for the year. The support test, again, for qualifying child. The child themselves must not have provided more than half of their own support for the year. Dependency, qualifying relative. Specific rules related to qualifying relative. The person can't be the taxpayer's qualifying child or the qualifying child of any other taxpayer. The person either must be related to the taxpayer in one of the allowed ways or must live with the taxpayer all year as a member of their household, and the relationship must not violate local law. The person looking to be claimed as a dependent cannot have gross income for the year of $4,150 or more. The taxpayer must provide more than half of the person's total support for the year. Filing status, head of household and single. A taxpayer may be able to file as head of household if they meet the following requirements. They are unmarried or considered unmarried on the last day of the year. They paid more than half the cost of keeping up a home for the year. A qualifying person lived with them in the home for more than half the year, except for temporary absences. However, if the qualifying person is a parent, they do not have to live with the taxpayer. Head of household is a filing status for unmarried people. However, certain married persons can be head of household, those who are married but considered unmarried. To be married, but considered unmarried, on the last day of the year, all of these tests must be met. They must file a separate return. And that includes married filing separate, single, or head of household. They must have paid more than half the cost of keeping up a home for the tax year. The spouse did not live in the home during the last 6 months of the year. So typically that means from July 1st onward, the spouse was not in the home. The spouse is considered to live in the home even if he or she is just simply temporarily absent. The home was the main home of a child, stepchild, or foster child for more than half the year, and must be able to claim the child as a dependent. However, if they can't claim the child simply because the non-custodial parent can claim under an agreement between the parents, that does not prevent being considered unmarried or head of household. As far as single filing status is single if the taxpayer is unmarried and they don't qualify for another filing status. So single is sort of what we fall back to. We would file single if they're unmarried and they don't qualify for another unmarried filing status. In that case, we'll choose single. Taxpayers can choose married filing jointly as their filing status if they are considered married and both spouses agree to file a joint return. On a joint return, the spouses report combined income and deduct combined allowable expenses. They can file a joint return even if one of them had no income or deductions. Both spouses may be held responsible jointly and individually for the tax and any interest or penalty due on a joint return. This means that if one spouse doesn't pay the tax due, the other may have to. Or if one spouse doesn't report the correct tax, both spouses may be responsible for any additional taxes assessed by the IRS. One spouse may be held responsible for all the tax due, even if all the income was earned by the other spouse. This is known as joint and several liability. Taxpayers may want to file separately if they believe their spouse isn't reporting all of his or her income, or they don't want to be responsible for any taxes due if the other spouse doesn't have enough tax withheld or doesn't pay enough estimated tax. If a spouse dies during the year, the surviving spouse can use married filing jointly as the filing status for the year of death, if otherwise qualified. The year of death is the last year for which they can file jointly with their deceased spouse. They may be eligible to use qualifying widow or widower as a filing status for the 2 years following the year the spouse died. For example, if a spouse died in 2017 and they haven't remarried, they may be able to use qualifying widow or widower for 2018 and 19. The standard deduction for taxpayers who don't itemize their deductions is higher for 2018 than it was for 2017, as we see from Table 6, which is the standard deduction table that most taxpayers would use. The standard deduction is higher for taxpayers who are 65 or older or are blind. The standard deduction amount depends on filing status, whether they're 65 or older or blind, and whether another taxpayer can claim them as a dependent. We note this table is used to determine standard deduction for dependents. And as we note, earned income on line 1 here would have a significant impact on the amount of the standard deduction for a dependent. U.S. citizens or resident aliens need to determine their gross income, their filing status, their age, and whether or not they're a dependent to determine if they have a filing requirement. Filing requirement is loosely based on standard deduction. The determination of whether or not a dependent is required to file a tax return is more complex and is often the requirement is often at a lower amount than for non-dependents. We see the table for most taxpayers as far as when they're required to file a return, and we also see the calculation, even though it's a little bit small to see it in detail. We see the calculation needed to determine if a dependent must file a return. Taxpayers needing more time to file their taxes can get an automatic 6-month extension from the IRS. For most taxpayers, the tax filing deadline is April 15th. April 15th can be extended if it falls on a weekend. Also, local factors such as Patriots' Day in Massachusetts or Emancipation Day in the District of Columbia can extend the deadline for taxpayers living in the impacted locality. There are a few different ways taxpayers can file for an extension. The IRS must receive an e-filed extension by midnight on the day of the filing deadline. Taxpayers can request an extension using the application for automatic extension of time to file. That can be filed either manually or through the mail or electronically. The IRS will automatically process an extension of time to file when the taxpayer pays all or part of their taxes electronically by the April deadline. They don't need to file a paper or electronic form 4868, which is the form mentioned before, when making a payment with the IRS Direct Pay or the electronic federal tax payment system or with a debit or credit card. When paying one of these ways, taxpayers will select extension as the reason for the payment. Taxpayers should print out a confirmation as proof. More time to file is not more time to pay. An extension to file gives taxpayers more time to file their returns, but not more time to pay their taxes. Taxpayers should estimate and pay any taxes owed by the April deadline. Aliens, in other words, those who are not a U.S. citizen, are considered a non-resident alien unless they meet one of two tests. They can be a resident alien of the United States for tax purposes if they meet either the green card test or the substantial presence test for the calendar year. They can be both a non-resident alien and a resident alien during the same tax year. This usually occurs in the year they arrive or depart the United States. If so, they may elect to be treated as a dual status alien for the taxable year and a resident alien for the next taxable year if they meet certain tests. They're a resident for U.S. federal tax purposes if they are considered a lawful permanent resident of the United States at any time during the calendar year. This is known as the green card test. They are a lawful permanent resident of the United States at any time if they've been given the privilege, according to the immigration laws, of residing permanently as an immigrant. They generally have this status if U.S. Citizenship and Immigration Service has issued them an alien registration card, also known as a green card. They continue to have U.S. resident status under this test unless they voluntarily renounce and abandon this status in writing, their immigrant status is administratively terminated by the federal government, the U.S. government, or their immigration status is judicially terminated by a U.S. federal court. If they meet the green card test at any time during the calendar year, but do not meet the substantial presence test for that year, their residency starting date is the first day on which they are present in the United States as a lawful permanent residence. However, an alien who has been present in the United States at any time during a calendar year as a lawful permanent resident may choose to be treated as a resident alien for the entire year. Taxpayers will be considered a U.S. resident for tax purposes if they meet the substantial presence test for the calendar year. That's the second test, the substantial presence test. To meet this test, they must be physically present in the United States on at least 31 days during the current year and 183 days during the 3-year period that includes the current year and the 2 years immediately before that. Counting all days they were present in the current year, 1/3 of the days they were present in the first year before the current year, and 1/6 of the days they were present in the second year before the current year. The individual shared responsibility provision requires each member of a family to have qualifying health care coverage, qualify for a coverage exemption, or make an individual shared responsibility payment when they file their federal income tax return. In other words, to restate, requires that they have coverage, that they have an exemption from coverage, or that they make a payment because they did not either have coverage or an exemption for coverage. Qualifying health care coverage is also called minimum essential coverage. Under the Tax Cuts and Jobs Act, taxpayers must continue to report coverage, qualify for an exemption, or pay the individual shared responsibility payment for tax years 2017 and 2018, but not beyond that. Some examples of coverage that qualify as minimum essential coverage: employer-sponsored coverage, individual health coverage, or coverage under government-sponsored programs. U.S. citizens who are residents of a foreign country for an entire year and residents of U.S. territories are considered to have minimum essential coverage for the year. FBAR and Form 8938. A U.S. person, including a citizen, resident, corporation, partnership, limited liability company, trust, and estate, must file the Report of Foreign Bank and Financial Accounts, FBAR, Foreign Bank and Financial Accounts Report. On FinCEN Form 114, to report a financial interest in or signature or other authority over at least one financial account located outside the United States if the aggregate value of those foreign financial accounts exceeded $10,000 at any time during the calendar year. Generally, an account at a financial institution located outside the United States is a foreign financial account. The FBAR is an annual report due April 15th following the calendar year reported. Taxpayers are allowed an automatic extension to October 15th if they fail to meet the FBAR annual due date of April 15th. They don't need to request an extension to file the FBAR. Form 4938, Statement of Specified Foreign Financial Assets. Specified individuals and specified domestic entities that have an interest in specified foreign financial assets and meet the reporting threshold are required to file Form 8938. Specified individuals include U.S. citizens, resident aliens, and certain non-resident aliens. Specified domestic entities include certain domestic corporations, partnerships, and trusts. The reporting threshold is based on total value of assets. For specified individuals living in the U.S., unmarried individuals, the total value of their assets was more than $50,000 on the last day of the year, or more than $75,000 at any time during the year. For married individuals filing jointly, total value of assets was more than $100,000 on the last day of the year, or more than $150,000 at any time during the year. Higher amounts apply to individuals living outside the country. Innocent spouse and injured spouse. Innocent spouse allows a spouse to be relieved of joint and several liability on a joint return. Innocent spouse, relief of joint and several liability on a joint return. There are three types of relief from the joint and several liability of a joint return. Innocent spouse relief provides relief from additional tax owed if the spouse or former spouse failed to report income, reported income improperly, or claimed improper deductions or credits. Separation of liability relief provides for the separate allocation of additional tax owed between taxpayer and spouse or former spouse. The current spouse would apply if they're legally separated from or not living with the spouse when an item wasn't reported properly on a joint return, and that is specifically related to separation of liability relief. If people are still married, they need to be living apart when the amount was incurred. And then lastly, in regards to innocent spouse, equitable relief may apply when they don't qualify for innocent spouse relief or separation of liability relief. And something not reported properly on a joint return and generally attributed to the other spouse. They also may qualify for equitable relief if the amount of tax reported is correct on a joint return, but the tax wasn't paid with the return. Now, on the other hand, injured spouses, they file a joint return and all or a part of their overpayment, their refund, was or expected to be applied, offset, to the other spouse's legally enforceable past due federal tax, such as I should say a legally enforceable past due federal tax, state income tax, state unemployment compensation, debts, child or spousal support, a federal non-tax debt such as a student loan. Those are some examples. Form 8379 is filed by one spouse, the injured spouse, on a jointly filed tax return when the joint overpayment was or is expected to be applied, offset, to a past due obligation. By filing Form 8379, the injured spouse may be able to get back his or her share of a joint refund. Let's look at some examples and questions. To qualify for head of household, taxpayers must pay more than half the cost of keeping up a home for the year. Include in the cost of keeping up a home all of the following except, well, rent is part of keeping up a home. Mortgage interest is part of keeping up a home if the home is owned. Food eaten in the home is part of costs of keeping up a home. What is not is clothing. Clothing does not belong on this list of items that are considered keeping up a home. The correct answer is clothing. An unmarried son lived with his mother all year. 25 years old at the end of the year. Gross income $5,000. He did not provide more than half of his support. In regards to dependency and head of household filing status, what is his situation? Well, in terms of dependency, he is neither a qualifying child nor is he a qualifying relative. Qualifying child, I mean, his age just knocks him out. Qualifying relative, he has too much income. So he's neither qualifying child or qualifying relative, therefore he's not a dependent. As far as being a qualifying a qualifying person for head of household filing status, that's a different story. Since he is unmarried, he does not need to be a dependent. So he lives with his mother, he's unmarried, he would be a qualifying person. He would be a qualifying person. So our correct answer is letter D, is letter D. Which of the following statements regarding extensions of time to file is correct? An automatic 6-month extension of time to pay tax owed can be obtained by filing 4868. The Form 4868, or any extension for that matter, does not extend the time to pay tax. It extends the time to file the return, not an extension of time to pay tax. An additional automatic 4-month extension. Well, this is more for old-timers like me. It used to be an additional extension could be gotten on Form 2688. Back then it was 2 months, but that is entirely gone, and now we have just simply a 6-month extension. Interest and penalty for late payment may still be charged even if an extension is obtained. That's true. That is true. There's the correct answer. And then an extension request for a 2000 return must be filed by June 30. No, it needs to be filed by April 15th. So letter C, that's our correct answer. And then lastly, which of the following is true regarding the report of foreign bank and financial account requirements, FBAR? The FinCEN Form 114 must be filed by anyone. No, not just anyone. We need more than $10,000 in the accounts. The due date for filing is July 15th generally. No, April 15th generally. The FinCEN 114 is filed with the current year tax return. No, it is not. It is filed separately through the reporting system for that is set up to meet these requirements. And then finally, the FinCEN 114 is filed online with Financial Crimes Enforcement Network. Yes, there we go. That is the correct answer. All right. Well, thank you very much for listening and taking part in the viewing of this video. We hope it was helpful.